Dan Passarelli here. Well, we're almost to the end of the year. We've got 2 full days of trading left. And, you might be asking, why do we have to work on New Year's Eve? Why is trading open? Wouldn't you think it would be closed? It's kind of a holiday. But what supersedes the desire for traders to relax a little bit is the desire for traders to make sure that their positions are where they need to be at the last minute of the day at the end of the year. And so we can often see some different moves and some different prices happening on New Year's Eve, especially in the last 5 or less minutes of the day. And the reason is what is called window dressing, end of year window dressing. And you can possibly see some weird prices on this day. So what happens is a couple of things. There's basically 2 different things that I would consider window dressing. One is traders who actively manage funds that invest in certain things, like maybe there's a technology fund. If they were holding on to this one stock because they think it's going to be a good one in the long term, but it really pulled back over the last couple of months and, it's trading pretty weakly, they might not want that stock to be printed in their prospectus based on their positions year end. So they might just sell it off. Or they may think that a stock is very, very overpriced and they didn't buy it, but it's up quite a bit on the year. And they also don't want to show their investors that they missed the boat. So they're going to want to own that stock at the end of the year, because a lot of funds will print, prospectuses or, PDF versions of it, of course, and whatever's held in their account in that last minute of the day when the bell rings on New Year's Eve, that's what shows up there. So they want to put on a good face and show that they're not holding a bunch of losing positions and that they are holding winning positions. Now, another thing that could happen, and this particularly can happen in smaller stocks, take a look at WWE here. So this one, there's not a real ton of open interest across the board. I mean, the shorter term ones, the front expiration, there's some, but then when you go further out in time, there's not as much. Well, if a market maker, a professional trader happens to be the person who is long most of this 414 open interest contracts, what might happen sometimes at the end of the year, in the last minute or seconds of the day, is you might mysteriously see a 25-cent bid for one contract go up. Now, why would that happen? Well, the market maker whose bonus is based on his profit and loss at the end of the year, if he bids up 25 cents, the mid-market price goes from 25 cents to 30 cents. So he just sort of magically made a nickel on 400 contracts, right? And so I'm not saying you will see this. I'm not saying you should see this. I'm not saying people do this, but keep an eye out for that, because it is something that, well, let's just say, could happen. And if you're looking to get out of things or maybe get into positions, there might be an opportunity there for you to get some prices that you otherwise could. This is Dan Passarelli. I hope that helps. Trade smart.